Hello everyone, I Dr. Namita Mishra, faculty of MBA from Tecnia Institute of Advanced Studies, going to deliver a lecture on accounting concepts and the basic principles. So accounting concepts are the basic principles and conventions are the established uses of accounting. So what are different accounting concepts are there? We will go through one by one. First one is business entity concept. According to this concept, the business and the owner of the business are two different entities. In other words, suppose I start a business, I and my business are separate to each other. We will take an example to go through it. For example, Mr. A start a new business in the name of Mr. and Mrs. or trading company and introduced a capital of rupees 1 lakh in cash. It means the cash balance of Mr. and Mrs. trading company will increase by a sum of rupees 1 lakh. At the same time, the liability of Mr. and Mrs. trading company in the form of capital will be also increased. It means Mr. and Mrs. a trading company is liable to pay rupees 1 lakh to Mr. A. So, due to this concept, capital treated as a liability instead of an asset to the business. Next one is money measurement concept. So, we will know what is it. It is most important concept of the accounting. According to this concept, only monetary transactions are recorded in books of accounts. Although non-monetary transactions like emotional attachment of employees towards the business has its value, has its place to the business, but due to non-monetary in nature that cannot be recorded in books of accounts. It means qualitative transactions have no place in books of accounts. Only the transaction that count through money that has the place in books of accounts. Then second concept is going concern concept. What does it mean? Going concern concept denotes that a business unit is a going concern. All the financial transactions of the business in keeping this point of view that a business unit is going concern, not a gone concern. Because of this concept, in the initial period, although the business suffer losses, the businessman continue the business with the assumption that after some period of time, the business will started making profit. Due to this concept, the banker provide loans, the supplier supply the goods or services to the business, the employees work properly. For example, a business which makes investment in form of fixed asset and we book only depreciation of the assets in our profit and loss account. Not the difference of acquisition cost of assets less net realizable value of the assets. The reason is simple. We assume that we will use the assets and earn profit in future while using them. Similarly, we treat deferred revenue expenditure and prepaid expenditures. The concept of going concern does not work in the following cases. If a unit is declared sick, unused or unusable units, when a company is going to liquidate and a liquidator is appointed for the same, when a business unit is passing through severe financial crisis. Then the cost concept. The concept based on the going concern concept. We take the value of assets on the cost basis, not on the realizable value or the market value of the assets, based on the assumption that a business unit is going concern. No doubt, we reduce the value of assets providing depreciation to assets, but we ignore the market value of the assets. Then, we know the dual aspect concept. There must be a double entry to complete any financial transaction. It means every debit should be always equal to a credit. Hence, every financial transaction of its dual aspect. Take and rule applies for a business transaction. When we give some benefit, we also take some benefits. For example, if we buy some stock, then it will have two effects. If we buy some goods, we receive goods and paid amount for the same. Then we know the accounting period concept. As per this concept, the life of a business unit is defined as per the going concern concept. You know, the life of a business unit is indefinite as per the going concern concept. To determine the profit and loss of the firm and to ascertain its financial position at the end day of the business year, different books of accounts are prepared like manufacturing and trading, profit and loss account and the balance sheet at a regular point of time. So we will know what is the regular point of time and what are the different periods of time that is taken. So for taking the different periods of time, there is no such hard and fast rule on fixation of that period. It is depending upon the number of transactions done by the business. It means accounting period may be 1 year, 6 months, 1 month, it may be quarterly like this. So due to this concept, revenue expenditure and the capital expenditure are segregated. Revenue expenditure are debited to the profit and loss account to ascertain the correct profit or loss during a particular accounting period. Capital expenditures comes in the category of those expenses where the benefit of which will be utilized in the next coming accounting periods as well. Matching concept. Matching concept is based on the accounting period concept. The expenditure of a firm or a company for a particular accounting periods are to be matched with the revenue of the same accounting period to ascertain accurate profit and loss of the firm for the accounting period. Let us take an example to understand the matching concept clearly. Suppose a company sales position for a particular period is 58,000. Total expenses outstanding including purchase of the particular concern is 48,000. So the profit of the business will be 10,000. In the above example, to match the expenditure and the revenue during the same accounting period, we added the credit purchases as well as the outstanding expenses of this accounting year to ascertain the current profit for the accounting period. Then we know the accrual concept. Accrual concept is the most fundamental principles of accounting, which requires recording revenues when they are earned and not when they are received in cash, and recording expenses when they are incurred and not when they are paid in cash. This is because under the accrual concept, revenues and expenses are recorded in the period to which they relate and not when they are received or paid. Application of accrual concept result in accurate reporting of net income, assets, liabilities and retained earnings, which improves analysis of the company's financial performance and financial position over different periods. Due to the presence of the concept, at the end of each reporting period, company pass adjustment entries to know the actual profit earned or the loss suffered for the business concern. Then we know the objective evidence concept. According to this objective evidence concept, every financial entry should be supported by some objective evidence. Like purchase should be supported by purchase bills, invoices, sales with sale bills, cash payments of expenditure with cash memos, and payment to creditors with cash receipt and bank statements. Similarly, stocks should be checked by physical verification with application of different valuation rules and system and the techniques of stocks, and the value of it should be verified with purchase bills. So, I hope you understand the concept of accounting well. Thank you very much.